Okay, so last week we started financial statement analysis, and I said that the this is one of the most common question in case study, and that there is no way you want to do a business analysis without considering the without considering the what do you call it, the interpretation of the financial statement. So we had a discussion about so many things. We talked about different types of analysis. We talked about vertical analysis, horizontal analysis, internal and external analysis. We talked about those last week. And at the end of before we close for last week, still last week we had we also talked about techniques for financial analysis. We discussed comparative financial statement, and I said this is when you have financial information of 2 or more years, right? Which should be which makes it which makes the analysis comparable. We also talked about common size analysis, and I said this is where we convert the items of the statement of profit or loss and statement of financial position as a percentage of one of the items there. So for statement of profit or loss, we usually convert all the items there as a percentage of what? Of revenue. Okay? All the items as a percentage of revenue, and statement of financial position, all the items of all the items there as a percentage of total assets. Right. So, and we discussed about the common size of profit or loss statement for DFFP, and I gave you a classwork to write on the three line items, just like I've done here. You know, gross profit is here, and cost of sales. I think we discussed about gross profit and cost of sales, right? And I said you should write on some other ones. Okay, so we are supposed to continue with this class today. Meanwhile, I also want us to, we have seen the common size of the profit or loss account. Okay, so so we should also look at the common size of uh, the statement of financial position. Okay, but then going back to the common size of this statement of profit or loss, I hope we can all write one or two things about it. Now, what we can see is that over the 3 years, the company has maintained, you know, direct cost to be 77% of 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 the revenue. Now, what that means is that for every 100 naira revenue made or sales made, about 77 naira will go to direct expenses, and there will just be 23 naira left to cover all other expenses. On one hand, we might say that they have been consistent in managing their direct cost. On the other hand, we might also argue that the percentage the direct cost is taken in the revenue is too high, leaving you know little margin for to cover for other expenses. Okay, and out of the 23 naira left, 17 naira we go to selling and administrative expenses, leaving just 6 naira to cover for interest and taxation, you can see. And at the end of the day, for every 100 naira between for 2017 and 2018, profit after tax is only 4 naira. The company make only 4 naira from every 100 naira sale made, and it declined slightly in 2019. I mean, what I'm saying is the same way you can make comments on these things, right? So I think that was where I gave you the assignment last week. I gave you the classwork last week. Okay, that was where we stopped, right? Okay, so I wanted to I wanted to now show you the common size of the financial position, right? Common size of the financial position. Now, so here is the thing about the financial position. The first thing you must understand about the financial position is that the basis of its preparation is based on the idea that when you are starting a business, I mean, this is the very basis. When you are starting up a business, what do? You raise capital. You start with your capital, right? Do you know we start with the capital? Excuse me, please. I'm coming. Give me a few seconds. I want to be seeing the class. Okay. I'm coming on. Someone sent a message. Deborah said she can't hear anything. I hope you can hear me now.
Yes, we can
Because
hear you, sir.
Mohammed has just confirmed it that he can hear
Yes,
me.
sir. That was before. That was before. I can hear you now.
Why now? Why is this thing not displaying very well? I want to be seeing what is going on in that class. All right. Okay, okay. It's supposed to be like this, right? This is what I want to see. All right. So this is the common size statement for DFFP for between 2017 to 2019. And I was saying that the basis for preparation, have which will have impact on the analysis, is that when you are starting a business, right? Right? What do you need? You need your capital. Okay, you need your capital in form of maybe some cash, maybe uh, some other things like that, right? You need basically your cash to run the business. Now, at every point in that cash you have put into the business to start the business, what do you use it for? If the business is into maybe transportation business, that means you have to buy, let's say, a vehicle, a motor vehicle, right? Maybe you have to furnish your office, buy AC, buy some other things like that, right? So at every point in time, the capital you have contributed to the business must be equal to the asset of the business. This is what we call the accounting equation. This is accounting equation, which states that the capital of the business, the amount the owner put into the business, must be equal to what? The asset of the business. Meanwhile, so as the business is growing, right, most of the time the owner might not have additional capital to invest in the business, and there may be need to now take external loan, right? Now that means the capital has been increased with what? With liability. Therefore, at every point in time, the capital of the business plus liability must be equal to the total assets of the business. And now, if you look at this common size statement, you will see that here we have the assets of the business, right? Here we have the asset of the business, and you can see that the asset is made up of the non-current assets and the what? And the current asset. And we have the total here, 100%. Okay. Now, if you look at the other section, the equity and liability. The equity and liability. If you look at the equity and liability, what do you notice? The equity is, the total of the equity is what? Here is 25%, 43%, and 47%. And for the liabilities, right, we have 75. So it means that for we to get the total equity and liability, we add the 25 plus 75%, which will give us this 100%. And that is how the balance sheet can balance, or that is how we come about the balancing of the balance sheet. Okay, so you see the equity and the liability make up what? Resulting to the what? The total asset. So it means that the total asset here, the total asset we are seeing here, has been financed by what? By the equity and liability. Meanwhile, there is a rule also that when you are financing, okay, you always finance non-current non-current assets with what? With current, with non-current, with non-current liabilities. The idea is that the non-current asset are assets that you use over a long period of time. And when you are financing such, you should take long-term what? Obligations that will give you enough time to do what? To repay back. Okay. And again, when you are financing current assets on the other side, okay, current liabilities can be used to finance it. Okay, because this is the working capital of the business and it must be settled. The current asset must be able to settle what? The current liabilities as at when it's fall due. Now let's go back to this common size. So you will see that in 2017, let's see the mix of the asset. In 2017, see the mix of the asset. The asset, the non-current asset, was 52%, okay, of the total asset, while the current asset was only 48%. We can say that is fine, right? Okay, so the company is holding more like a balanced non-current asset and current asset. However, look at it. In 2018, the non-current assets declined. It declined from it declined from it declined from 20 from 52% It declined from 52% to what? To 44%. Then we can say what could have happened? What what could have happened? Two things could have happened. It's either that is due to depreciation. It's either that could be due to depreciation, or it could be that the company disposed of some of the assets. Now, if you see, if you now look at the current asset, if you look at the current asset, you will see that the current asset on the other hand, increased. Does that mean that the company sold off some of its non-current assets in order to have what? Cash. Maybe cash, maybe some inventory. So it could be that the company is trying to be more liquid, or working on it, on managing its working capital, so that they can have enough cash to settle what? To settle the non-current liabilities as at when they fall due. So we can prove that. So if you look at the if you look at if you look at if you look at the liability section, you will see that the liability was high. The liability was high, was 75% in 2017, and became what? And became 57% in 2018. So it could be that they were trying to they noticed that they have so much non-current current liabilities, and they needed to sell off some of their assets in order to what? To settle it. And that's why the current liabilities decreased here. Now, in 2019, the non-current asset decreased further to what? To 35%, and the current assets increased more to 65%. That is what has happened to the asset section of the account. Now, the question we should now ask ourselves, remember the accounting equation. We have seen the assets, so we can ask ourselves as accountant, as professional accountant, that how did they finance the assets? That is the question we should ask ourselves. Remember, we said that when you are financing, there is a rule that the non the non-current assets must be financed with what? With non-current liabilities, right? And the current assets should be financed with what? With current current liabilities, right? So let's see how they finance the asset. Okay, so in 2017, we had 52% of non-current assets. So how did they finance it? Do they have any non-current liabilities? The answer is no. No current liabilities. This means that the company used the current liabilities to finance its what? Its non-current asset. Now, what that means is that they took bank overdraft. They took bank overdraft to do what? To finance non-current asset. Now, the implication is that most of the time bank overdraft are meant to be settled on a daily basis, right? Most of the time they are meant to be settled on a daily basis. And if at the end of the day you are unable to repay back, right, the following day you have to pay back the interest with penalty. And imagine if the company is unable to pay for 2, 3, maybe 4, 5 days, what could happen? That could that could lead to the creditors requesting for the company to be liquidated so that they can recover their money, right? So that will increase the liquidity risk of the company. That is a form of liquidity risk. And not only liquidity risk is that the risk that they might not be able to meet up with their to settle their liabilities when they fall due, right? But that may not be only the issue. The other issue will be that yes, it may also increase their finance risk. What is finance risk? The risk that the company may not be able to raise more finance in the market, right? Now, so if for instance DFFP now decide to go and get more loan, right? The first thing the bank will request for is what? Is their balance sheet. Okay, we have submit your account for the last 5 years. So when they see the account, they will come here and see that the total liability of the company is 75%, right? That means the company is highly what? Highly geared. So that is finance risk. Nobody will give you more loan when you are already highly geared. Okay. Now, in 2018, what happened? They paid off some of the current liabilities. So it could be that they've now realized that, oh, this risk that we are facing could lead to the end of this business. So they had to sell off some of these assets in order to have cash and to settle what? To settle the uh, current liabilities. And you can see by the time they got to 2019, they have reduced the current liabilities and they have added non-current liabilities. So it means that they have moved from more of external financing to what? To more of to a balance of internal and what? And external financing. So the total liability became 53%, and the what? And the equity is now what? 47%. That's more like balance. And they have improved the equity through what? Through retained what? Earnings. It means because they are looking at internal financing option in order to improve their what? Liquidity and finance risk, right? So how can we make comment on this? How can we make comment on this? So we can make comment based on what we see, what we have just said, right? So most of the time we make comment based on the items. Okay? Okay? So let's see a comment here. The comment on current asset. The current asset, excuse me, please. Current assets have increased. Current assets have increased from 48% in 2017 to what? To 65% in 2019. This shift towards a larger proportion of current assets suggests a focus on improving what? Liquidity. The company wants to improve liquidity, or a strategic move towards what? Short-term investment. Short-term investment. Maybe they are considering short-term investment, or they are managing their what? Their working capital. Then we could make current comment on non-current assets. Let's see the comment on the non-current asset. The percentage of non-current assets, right, has decreased steadily. It has decreased steadily from what? From 52% in 2017 to what? To 35% in 2019. This decline indicates that the business may have sold off or depreciated long-term assets, possibly to restructure its operations or reinvest short-term activities. Okay? Then the the liabilities, the liability section of the account. Let's see the comment. Non-current liabilities made up what? In 2019, non-current liabilities make up 29% of total financing, but they were not reported. Okay? Okay. However, the current liabilities, right, have declined significantly from 75% in 2017 to 24% in 2019. This drop indicates a reduction in short-term financial obligations. So they have reduced their short-term financial obligations, potentially reflecting improved what? Improved liquidity. Because they have sold off some of their assets in order to have enough money to pay it off, or better management of short-term debt or repayment of significant short-term liability. It may also suggest a more balanced approach to financing with less reliance on what? On short-term debt. Okay. What about comment on the shareholders' equity? Comment on the shareholders' equity. The proportion of the total shareholders' equity has increased from what? From 25% in 2017 to what? To 47% in 2019. Retained earnings have shown substantial growth from 20% in 2017 to what? To 43% in 2019. Indicating what? One, improved profitability. If retained earnings has increased, it shows that the business is profitable. Or reduced dividend payout, or because they have reduced their dividend payout, which allow the company to what? To reinvest profit back into the business. The core of share capital has fluctuated slightly but remain a smaller component of the what? Of the equity, as it remains between what? 4 to 6%. So the overall comment is that, let me give you an overall comment. The company in 2017, the company relied heavily on short-term liabilities, which stood at 75% for financing. Shareholders' equity was only 25%, indicating a high dependency on what? On external short-term funding. Just like what we said the other time, potentially increasing what? Risk of liquidity. Risk of liquidity. Now, in 2018, there is a shift in financing with liability still dominant at 57%, but shareholders' equity rises to what? To 43%. This suggests some reduction in short-term debt and an increase in what? In internal funding. However, in 2019, there is a more balanced mix between what? Between equity. A more balanced mix between equity at 47% and what? And liabilities at 53%. And the introduction of non-current liability of 29% shows a move towards what? Long-term financing, reducing the reliance on short-term debt. Okay. The increase in equity and retained earnings indicates a healthier. Now, because the equity and retained earnings has increased, it indicates what? A healthier, more sustainable capital structure with business relying more on internal what? Financing. Okay. So that is how we can also make comment. However, please let me state it clearly now. For the purpose of this exam, for the purpose of this exam, except otherwise stated, except otherwise required, please please stick with ratios and trend analysis. Please, for the purpose of the exam, for the purpose of the, you should stick with what? Ratios and trend analysis. And one reason is that, you see, although I always like to interpret my to do my financial statement analysis uh, with, yes, ratios and trends, in addition to while adding what? Common size analysis. You know, common size, see, if you look at the common size, this looks more like when we are extraying the what? The financial position of the company. Okay, this looks more like an x-ray of what is really going on in the financial position of the organization. So it gives you more points to back up your position when you are interpreting the financial statement. But however, for the purpose of this exam, we should stick with just what? We should stick with just ratios and trend analysis. So that takes us to trend analysis. Trend analysis helps us to, I think we have discussed on trend analysis a bit the other time. Okay, but basically it helps us to show the movement, the changes in the items, the changes in the items of financial uh, performance or financial position. That is trend. So here is the trend for the statement of profit or loss of uh, DFFP, right? So we have the 2017-2018 period and the 2018-2019 period. So so the major thing we do in trend is that the first thing is, okay, let me give you the formula. For us to compute trend, we use a formula: old, sorry, new minus old, okay, okay, divided by divided by divided by old, then multiply by what? 100. This will give us the percentage. This will give us the percentage change. Okay, so we are looking at two things in trend analysis. We are looking at the percentage what? The percentage change, and we are also looking at what? The absolute change. The absolute change. That is the naira what? The naira change. So the naira change will just be new minus what? New minus old. Okay, new minus old. So the 2018 revenue minus 2017 revenue will give us this 12.9 million naira. Okay, and this is just 17% what change. It's just 17% change, and the 2019 revenue minus 2018 revenue will give us 17.2 million naira, which is just 19% change. Okay, 19% growth in revenue. This is 17% growth in revenue, and that is what we have done here. Okay, that is what we have done here. So, so then you have to know how to. I think we have made the comment on trend analysis earlier. Let me see if I can see it. Yes, we have done that earlier. And comment, please. Okay, I think we did not do that, right? Okay, so here is it. Here is how to make your comment on trend analysis. So I can say that the the revenue the revenue of DFFP experienced growth between 2017 and 20 what 18. The revenue increased increased by what? By 17%, which amounts to about 12 point what? 12.9 12.9 million naira. Between 2018 and 2019, between 2018 and 2019, DFFP revenue also increased by what? By 19%, to the tune of about what? To the tune of about what? 17.2 million naira. 17.2 million naira. That is how to make comment on trend. Okay, that is how to make comment on trend. Okay, then for cost of sales, you do the same thing for cost of sales. So let me give you because you have to practice this. So in the chat box, very quickly, in the chat box, write on the trend of cost of sales and gross profit classwork. Okay, I'm waiting. I'm reading the comment, please. And let's be fast with it. So this is what we have been doing now because we notice that many of our students we are noticing a kind of I don't want to call it laziness, whereby students are given assignments and they won't do it. They are given work to
You have
do,
to
they
move the
won't do it.
screen up a
So
little bit.
we the lecturers have now agreed that instead of giving them homework, let's give them in the class so that they can do it right there in the class, because we know they will not attempt it when they go home. So that is what we have been doing. So in the physical class, I've been giving them classwork and they will write.
Let's move
Okay, in
move the
fact
page
today
up a little bit.
I dictated that they wrote and wrote and they were almost tired. And again, this is the first step in writing. You know, you have you have started learning how to write already by doing all these classworks. So I'm reading in the comment section. So what you will do, you don't need so much to write all these things. Oh, just follow it. You can see the way I have written this thing. Just do the same thing. Just say that the gross profit of DFFP, because this is an increase, has increased by what? By 17% from 2017 to 2018, to the tune of about what? About 2,919,000 naira. Okay, it further increased by 19% between 2018 and 2019 to the two. It's a very simple, very simple. So I'm reading. No one is writing yet, so I'm reading. No, so that I can move forward with this class. If possible, I need to round up the ratio, the financial statement analysis class today, if possible. Okay, Mohammed said we are doing it. Okay. Okay, so I need to continue now because I need to round up this class today. So while I'm waiting for that, now the next technique we are going to look at is ratio analysis. You can see we are looking at those techniques. We have seen the common size analysis, and let's look at ratio analysis. So we have also looked at trend analysis. So now let's consider ratio analysis. So ratio analysis is one of the most common analytical techniques. And what is ratio? Ratio is quantitative, shows the quantitative relationship between two or more items on the financial statement. It shows the quantitative relationship of two or more items. Okay, that is the financial ratio. It shows the quantitative relationship between two or more items. That is why you see you combine some items, you combine items on the statement of profit or loss with statement of financial position, or on the statement of financial position, or on the statement of profit or loss, in order to interpret the financial information. So let's look at the various types of ratios that we have. So I've put the types as an acronym, PALI, right? So we have the profitability ratios, we have the activity ratios, we have the liquidity ratios, the long-term solvency ratio or leverage ratio, and lastly, the investment ratios. So one thing you should note about ratio is that one,
You can see your screen.
can have one ratio can have up to 2 to 3
I
formulas.
feel he's not hearing us,
So
but
my
we can hear
idea for
him.
you will be that you should a formula that you like, pick a formula of a ratio that you feel comfortable with and stick to it. Not that you will be you
Can, we
use
can
it,
we can
you use
we can
one
see
of
your
the
screen.
formula today, use another version tomorrow. That could get you in trouble in the exam, and that could lead to confusion. So stick to one particular formula of a particular ratio. Okay, and you can't see my screen. Oh, okay, let me share this one. Okay, I think my comments are coming in. Mohammed has turned in his trend comment because of sales of DFF in 2017 and 2018 is 17% with the tune of 10 million, while it increased in so so and that is why we have been trying to. Yes, so I can't hear anybody. Oh. Yes, I can't. I don't know why. I don't know why. So, Mohammed, good job that you have tried, but you can see that what you have written now, to me, I can't find any meaning to it, right? Because the sentence is not communicating any meaning, right? Right? Yes, that is why you have to continue to practice. Very simple. You wanted to say the cost of sales. It should have been that the cost of sales of DFFP increased increased between what 2017 to 2018 by 17% to the tune to the tune to the to the tune of to the tune of about this one is you even put 10,000 naira to the tune of, let's say, 10 million naira. I'm just correcting what you wrote here. Oh. While it increases in 2018 to 2019 by 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 17% to the tune to the tune to the tune of about, let's say, 19 point or 19 million. Let me just put 19 million there. Okay, that is how you should have written it. Okay, okay. uh Deborah, gross profit increased from 2017 to 2018 by 17% with to the tune of, not with the tune, sorry, not with the tune of, so it should be to the tune of, or amounting to the gross profit increase from 2018 by 17% to the tune of to the tune of 2.9 million naira. It further increased by 19% to the tune of 3.9 million from good. Deborah, fantastic. Yes. Okay. Okay. This is how to write it. Right? Good. Good. So let's look at profitability ratios. Let's look at profitability ratios. And the first ratio we consider here is the return on capital employed. Is the return on capital employed. Okay? Return on capital employed. And the formula is profit before interest and tax all over share capital plus reserve plus non-current liabilities which is also the same as profit before interest and tax over what? Over net asset. Okay, Now, so that we should be clear, when we are picking our figures, our profit before interest and tax is revenue, or someone said in the class there, someone got confused and said I should rather say gross profit, right? I should rather say gross profit plus. But I don't want to say that. It will be revenue, sorry, it will be revenue minus 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 cost of sales, minus cost of sales minus operating expenses. That is our profit before interest and tax. While our net assets, our net assets is equal to total assets minus current liabilities, right? Minus current liabilities. So you can check your document. You can check your document and give me the uh yes, check your document and see and check those figures, so those figures should look more like this, right? They should look more like this. If you check them, the 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 profit before interest and tax is also, you can also call it, the PBIT is equal to operating profit, is equal to operating profit, which is equal to revenue minus cost of sales minus operating expenses. So you will see your operating profit. That is the profit before interest and tax we are using, operating profit. So you can check it. So we should have something like this. So again, when you are presenting your ratio, look at the presentation here. You will see at the top we have the ratio, we have the group of ratio, the group we are computing, then the formula you are using, and the years you are computing on must be properly spelled out. Okay, you must arrange your table very well when you are computing. You have seen the trend too. Yes, so it must be properly laid out. So please kindly confirm this figure for me. The answer for 2017, is it correct? Is it correct? Because I have 66% here. In the class, they gave me 90, I think 96%. So I don't know where the error is coming from. Whether it's from my Excel, because I use Excel to
$96.
do the ratio analysis. So I don't know if it is Excel that is giving me error. So please confirm this figure for me, this 2017 figure. Someone should confirm it for me, please. Okay, it's 96%. Okay. Okay, all right, all right. So let's stick with 96%. Let's stick with 96%. Okay? Okay? So that is our ratio. Meanwhile, you know, the computing the ratio, you can see that anybody can compute this figure, anybody can compute this ratio, right? So the major thing in ratio is is how to how to explain the ratio, right? Is how to explain the ratio. That is the major thing in ratio analysis. How do you explain it? How do you explain it? So explaining the ratio, we are going to follow 3 steps. Steps in interpreting financial ratios. Step one. Step one. You tell us the significance of the ratio. You tell us the significance of the ratio. by looking at uh, the the definition, the significance of the ratio. Number two, you tell us, you identify reasons. You should identify the reasons for the the changes in the ratio. Why has the ratio changed over the year? Now, when you are looking at when you are looking at that, you should look at it from the angle of the numerator and the denominator of the ratio. You can see, you can explain the changes based on what, the numerator and the denominator. and and secondly and secondly you can explain the changes based on what, based on the contextual information, based on the contextual information based on the contextual information given in the exam. Okay, based on the contextual information. And lastly, you make recommendations. Later on, you will see the reason why you must start making recommendations immediately when you are explaining your ratio. So let's see the interpretation of this ratio. That is the definition. It helps us to measure how efficient, how well a company is making from what? From the capital employed. How well it is utilizing the capital employed to generate what? Profit. Now, for DFFP, the rules demonstrate a significant decline in what? In efficiency over the 3 years under review. So since rules measure returns okay, relative to the capital employed, right? In 2017, DFFP achieved a ROAS of 96%. Why? Right? Which indicates that for every 100 naira of capital employed, DFFP generated what? A return of what? 96 naira. You can see. So you can see that we are looking at the significance of the ratio based on the definition. This suggests strong operational performance and effective utilization of capital during that year. The company's high growth indicates a robust ability to generate what? Substantial returns from its capital. That is for 2017. So let's see for 2018 and 2019.
We can see your screen, sir.
However, in 2018, the rules improved. The rules, this should have been declined. The rules declined. The rules declined to 67%, indicating a slight what? A slight decline in efficiency. A slight decline in. This suggests that DFFP maintained DFFP failed, okay, failed to maintain what? Failed to maintain what? Effective capital management and operational efficiency during the year, managing to achieve even higher returns, right? Like that, right? Okay. Now in 2019, the rules fell significantly to what? To 33%. You can see, to 33%, reflecting a sharp increase in capital employed relative to profitability. This substantial drop suggests that they've every increased capital employed without a corresponding increase in what? In returns. In returns. Potentially due to growth of the economy. So let me just stop it here. Okay. It declined because what we are saying is the reason why it got here is because see, although the returns increased from 5.1 million naira to 6.1 million naira. However, the capital employed doubled, more than doubled, right? More than doubled from 7.6 million to what? To 18.4 million naira. It's more than double. So it's 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 made the rose to fall significantly. So this is what we have done here is we have looked at the significance of the ratio through the what? Through the through the definition of the ratio, right? So we have seen the significance of the ratio. That's what we have seen now. Okay, that's the significance of the ratio. Then the next step is to identify reasons for the movement in the ratio across the years. So let's see the reason for the movement in the ratios. Okay, let's see the reasons. So the first one is they say we should look at the numerator and the denominator. Let's see. A number of reasons account for the deterioration in the value of rows. In 2017 and 2018, the company maintained a relatively high, is not stable, a relatively high rows with what? With profit before interest and tax being what? Being this. Okay, okay, in 17 and 18, look at it, you right? And increase to this in 2018. Why the capital employed was this in 2017 and rose to this in 2018. The high rose values, the similar high rose values in these years indicate that the increase in profit kept pace with the increase in what? In capital employed. Remember I told you that you can look at the numerator and the denominator. So you will see that why this one increased slightly, why the PBIT increased slightly, the capital employed also increased slightly. I mean, so that is why the we have the high rose in these 2 years. Okay, that's what that point is saying, right? However, in 2019, in PBIT increased to 6.1 million. Why capital employed surged, okay, or shoot up to 18.4 million naira, more than doubling from 2018. This sharp rise in capital employed without a proportional increase in operating profit diluted the returns. That was why the returns fell significantly, leading to steep fall in rows from what? From 67% in 2018 to 33% in 2019. The company's ability to convert growing capital base into profit was 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 the company's ability to convert its growing capital base into profit was significantly weaker in 2019. So we have tried to use the numerator and denominator to explain the possible reason for the what? For the ratio, right? The other reason we can look at is we can look at the contextual factors, any contextual factors which could have led to the changes in the ratio. Contextual factor could be more data given. Maybe we have been given that, okay, this indicates the potential inefficiencies in capital allocation or underperformance of new projects. External factors. Now we are looking at external factors such as market volatility, increased costs, post-harvest loss, or operational challenges may have also hindered the company's ability to generate higher returns. In contrast, in 2017 and 2018, the, the in contrast, the years 2017 and 2018 demonstrate better capital management, where increased profits closely match the growth in capital employed, allowing JFF to maintain high ROEs. However, in 2019, the rapid expansion in capital outpaced the rapid, however, in 2019, the rapid expansion in capital outpaced profitability improvement, no leading to notable decline in capital efficiency. So we have used contextual factor information to explain the possible reason for the uh, for the for the decline. So lastly, we make recommendation.
Hello, we can see your
We
screen, sir.
make recommendation. That's the we make recommendation. DFFP should focus on improving the efficiency of its capital investment by aligning its expansion with proportionate what profit growth to restore and enhance its what its return on capital employed. Its return on capital employed. So that is how to interpret. You can see whoever reads this now, we get the we understand whatever the ratio is trying to communicate, and this is a proper way to tell the story or tell or explain the thing behind the ratio that you have computed. Okay, so please let's stop here tonight. I'm feeling very exhausted already. Let's stop here tonight. So let us stop here tonight, and let me give you some assignments. Let me give you some assignments so that our work will be faster next in the next class. So assignment, compute these ratios for me. Compute the following ratios. All these ratios, please compute it so that you just give me the figures next week. Okay, compute them for me. The return on equity, the gross profit margin, the net profit margin. Then you can also do the activity activity and efficiency ratios. Okay, the total asset turnover ratio, the non-current asset turnover ratio, inventory turnover ratio, the trade receivable turnover, the payables turnover, the trade payables period, and all of this. Please, you have it in that your note. So please compute all those ratios for me so that I can just explain some of them, and we can move to the next thing under the statement of finance. I mean under the financial statement analysis. So let me give you few minutes for to answer your questions. Okay, again, please note that you cannot you cannot write like this in the exam. Oh. This is just look at everything we wrote here now. Is much. Oh. You may not need to write that much in the exam. Okay, you may not need to write that much in the exam because you can't have all the time in the world to write this much in the exam. All right, who is raising up his hand? Mohammed, go on. I
Sir,
hope I will be able to hear what you are
we can
saying.
see your screen since, sir. Almost 10 minutes. We can see your screen, sir. Since.
Hello. Hello, Mohammed. I already. see the chat. Mohammed said, "Sir, ah, ewu, my screen went off. Jesus Christ." Okay, sorry. You will see it. I will send the updated material to you. You will see everything I've explained there. You see everything I've explained in the rows. No problem. Any other question? Any other question? I don't know what is wrong with my system. I can't say anything. And I even have my